So now that we know that every transaction must affect two accounts or more, let's get some practice with examples of using accounts receivable. So let's say you are Mary and you own a lawn mowing service. Now notice Mary's mowing service in the box on the lower left, she has zero revenue, zero cash, zero AR. Mary now has a customer, and her customer buys on account. So we got to learn what buys on account means. So Mary agrees to mow a customer's lawn once a month and allows the customer to pay 2 weeks later. So whenever you see this term buys on account, that means the customer is promising to pay later. So Mary's mowing service mows the lawn and the customer agrees to pay $50 in 2 weeks. So this means a transaction has occurred. So what does Mary record? Students usually like to analyze cash first. Is cash involved in this transaction? No, not yet, because the customer is going to pay in the future. In fact, the customer may never pay. Just because they promise to pay doesn't mean they will pay. So we're not dealing with the future, we're dealing with right now. So what Mary's going to record is she's going to record the amounts in mowing revenue and accounts receivable. Now in the future, Mary's business will receive payment from the customer. That's why it's called a receivable for Mary. So in Mary's mowing service in the blue box, we're going to add mowing revenue, $50. And to keep things simple, we're not going to use that grid system yet. We just kind of want to get practice with accounts receivable. And now she has accounts receivable of $50. Now on a piece of paper, Mary also needs to write down the name of the customer who owes her the $50. Just writing down that she has AR of $50 does not help her because she wouldn't know who owes her the money. But we're not going to write down the name. Just realize that she would have to do that. So again, let's talk about the tricky wording for customer buying on account. If the author was nice to you, they would say, Mary mows a customer's lawn and the customer promises to pay later. However, the textbook does not say that. It's going to say something like Mary mows a customer's lawn on account. So you need to realize that if it says the Mary mows a customer's lawn on account, that means that the customer is not paying now, but they promise to pay in the future. So now let's look at the customer's side of things. If the customer kept personal accounting records and asked you to help with the records, what would the customer record after their lawn was mowed? Doesn't the customer owe something? And isn't that debt owed within the next month? In fact, it's owed within 2 weeks. So the customer is going to record accounts payable. Remember, AP stands for accounts payable. Now remember, for the customer, if they were keeping personal finance records, they would need another account because their accounting equation would not balance. So besides accounts payable going up, what's the other account that they might record? Probably something called mowing expense or lawn maintenance expense. Basically, it's some type of an expense. Now, it's 2 weeks later. The customer pays $50 to Mary's business to pay the customer's account. What happens to Mary's cash account? So now we're back to Mary's accounting records. What's going to happen to Mary's cash? Well, her cash is going to go up by $50. Cha-ching! Now when the customer pays Mary, what happens to Mary's accounts receivable? Does that customer still owe $50? No. The customer no longer owes Mary $50. So Mary's AR decreases by $50 to 0. So now Mary has mowing revenue of $50, cash of $50, and AR of 0. If the customer is keeping personal accounting records, what would happen to the customer's records? Now remember, the customer had accounts payable of $50. So what would happen to the customer's accounts payable when they pay off the debt? the AP, accounts payable, would decrease by $50 to 0. And then cash would also decrease by $50 too. That's not shown on this slide. So now here's another warning for you about tricky wording that the authors use. Instead of being nice to you and saying, the customer pays $50 to Mary's business to pay their account, the authors will instead say, customer pays on account. Well, what does that mean? For Mary, that means Mary's cash increases and Mary's AR decreases because Mary's business no longer has a right to receive the $50 because the customer paid it off. So if you see customer pays on account, that means the customer is paying their debt to the business. So here's a summary about accounts receivable. Mary's mowing service sells a service on account. This means the customer will pay later. And what accounts are affected? Mary's business records would record an increase in accounts receivable because a customer owes them money. And since she did a mowing job, Mary's business would record an increase in revenue. And she would probably call that revenue account mowing revenue. Now, no company has an account called just revenue. You can have a revenue account for each type of service. Like she might have since she's a lawn mowing service, she might have a mowing revenue. She might have landscaping revenue, stuff like that. So remember, rule number 1, a transaction must affect 2 or more accounts. So when a business sells a service on account, AR increases and revenue increases. Now later, if the customer pays on account, remember this means the customer paid her debt to Mary, Mary's business would have to record an effect on 2 accounts. Accounts receivable would go down, so it's a decrease in AR, and her cash would go up because the customer paid her.